ACCTG. Okay, now let's go to current cost accounting. The last chapter included in our modules. So for current cost accounting, it's a method of measuring assets, liabilities, income, and expenses at current cost at the end of the reporting period. So we are now referring to the current cost at the end of the reporting period. Your current replacement cost is the estimated cost to acquire a similar asset at current purchase price. The essence of current cost accounting is the recognition of a holding gain or holding loss. So that is the very important item that we have to determine in connection with current cost accounting. If the replacement cost is higher than the historical cost, the difference is a holding gain. On the other hand, if it's lower than the historical cost, the difference is a holding loss. So in other words, if your current cost is higher than the historical cost, you'll have a holding gain. Then we have the realized holding gain or loss. It's considered to be realized gain or loss, being the difference between the current cost and the historical cost of assets sold or used during the year. The unrealized holding gain or loss is the difference between the current cost and the historical cost of the assets still on hand or unsold at the end of the year. So in other words, if the asset was already sold or used during the year, that's the time that you will be recognizing holding gain or loss. However, if it is still on hand or unsold at the end of the year, it's still considered to be unrealized. In other words, the basic principle that we have been studying, that if the item is still unsold, whatever gain or loss that you will recognize is still considered to be unrealized if the asset is still unsold. Now we go to the preparation of the current cost income statement. How do we record the various items in the income statement? So we begin with sales. Sales are made at the current selling prices throughout the period and therefore not restated. So unlike in the previous topic that we have to restate. This time, it's not restated, but we assume that they are made at the current selling prices throughout the period. Cost of goods sold. In current cost accounting, cost of goods sold equals the current cost of the unit sold at the same sale. So we have now the current cost of the unit sold. For operating expenses, they are measured at current cost when incurred. So during the time that the expense was incurred, these are already stated on a current cost basis. For depreciation, is based on the average current cost of the property, plant, and equipment. And for income tax, is already on a current cost basis. But the income tax is computed on the basis of income under historical cost. Now, these are the very, very important rules that we have to follow in connection with current cost accounting. Now we have the current cost statement of financial position. For cash and receivables, these items are already reported on a current cost basis in conventional statements and are therefore not restated. Inventory is stated at current cost at the end of the reporting period. Property, plant, and equipment. Land is stated at current cost at the end of the reporting period. Depreciable property, plant, and equipment are shown at current cost minus accumulated depreciation based on current cost at year end. For payables are conventionally reported on a current basis and therefore they do not need restatement. Share capital and premium, these are not restated. The balance of retained earnings is obtained from the current cost statement of retained earnings. So we have now the current cost, retained earnings beginning. We add the current cost net income from the total. We deduct the dividends declared or paid. So we have now the current cost retained earnings at the end of the period. Okay. Now, in connection with chapter 23, let's now involve or discuss some problems that will guide us in studying chapter 23. Okay. First, but before, let me give you the solutions or the letter answers to the multiple choice theory in chapter 22. I was not able to give this yesterday. So for problem 22-17, 1 to 10. Number 1, dog. Number 2, C. Number 3, dog. Number 4 and 5A. 6 also. So 4, 5, 6A. 7C, 8 dog, 9 and 10A. For 22-18, number 1 boy, number 2A, number 3 and 4 dog, 5C, 6 and 7A, 8C, 9 dog, and 10A. And last, for 22-19, number 1 boy, number 2A, number 3 boy, number 4 and 5C. All right, now those are the remaining two answers to the multiple choice theory. Now we go to chapter 23 for our problems. Let's begin from multiple choice problem number 1. There's only one straight problem here. So we now have problem number 23-1. The requirements are 1. What is the unrealized holding gain to be reported in 2020? So, unrealized holding gain. Now, we have the current cost on December 31, 2020 given at 600,000. So, we have now the current cost for 600,000 on December 31, 2020. Then the historical cost is given at 500,000. So we now get the requirement here is the unrealized holding gain to be reported. We now have the current cost end of 600,000 and we have the beginning of 500,000. The unrealized holding gain is 200 in 2020 is 100,000. Now we know that the land is still here, no? But the entity sold the land for 1 million cash on December 31, 2022. When on this date, the current replacement cost of the land is already 800,000. So what is the unrealized holding gain to be reported? It's still 100,000. Before the sale, unrealized for 100,000. In number two, the requirement is what is the unrealized holding gain to be reported in 2021. Take note that the land was sold for 1 million on December 31, 2022. So in other words, in the case of number one, asking for unrealized holding gain in 2020, that was the time that the land is still on hand on December 31, 2020. So in other words, it was still unsold. That's why there may be a holding gain, but it's still unrealized. So number one answer is C. What is the unrealized holding gain to be reported in 2021? On December 31, 2021, the land has a current replacement cost of 750,000. So, 750,000, we deduct the historical cost of 500,000. So, the cumulative unrealized holding gain in 2021 is 250,000. However, we already had an unrealized holding gain in 2020 of 100,000. So we have to deduct this from 250,000. So the unrealized holding gain to be recognized in 2021 is 150,000, and that is B as in boy. Third, what is the realized holding gain to be reported in 2022? Now we already call it realized because the land was already sold on December 31, 2022. And as stated, the current replacement cost of the land is 800,000. So 800,000 here for the current replacement cost at the end of 2022, but the historical cost is still the same. So we have the realized holding gain in 2022 equal to 300,000. But we have to deduct the unrealized holding gains in 2020 and 2021 for a total of 250,000. So we now have the realized holding gain to be reported in 2022 is only 50,000. That's your realized holding gain. So we have letter C for number 3. For number 4, what is the gain on the sale of the land to be reported in 2022? The selling price of the land is 1 million and the current cost is 800,000. So actually, we have been updating the record since numbers 1, 2, and 3. And finally, in number 3, we have the recognition of the current replacement cost. So we just compare it with the selling price of 1 million. The difference is 200,000 being the gain on the sale of the land. So the gain on the sale of the land would be 200,000. Okay. Now, in your income statement for 2022, we are going to show the following other income items. One is realized holding gain amounting to 50,000, and we still include gain on sale of land that is equal to 200,000. Okay, but if you try to recognize the actual gain on the sale of the land, it's 500,000. Since the selling price at the end of 2022 is 1 million and the historical cost was only 500,000. That's why the actual gain is 500,000. Only the net amount of 250,000 is reported in 2022 because the balance of 250,000 was already recorded partially in 2020, 100,000, and in 2022, 150,000. So all in all, you have the gain, you have the actual gain of 500,000. Okay, we go to problem number 2. Again, we have 4 questions. And number 1, what amount of depreciation should be reported in the historical cost income statement for 2020? Now, the historical cost depreciation. The company acquired an equipment on January 1, 2024, 5 million. Depreciation is computed using the straight line method and the useful life of the equipment is 5 years with no salvage value. So computing for the depreciation during the year by using historical cost, simply to divide 5 million, the historical cost, by the estimated life of 5 years. So we get 1 million. And that is letter A. Next, number 2, what amount of depreciation should be reported in the current cost income statement for 2020? So we already have a current cost income statement, and yet we still have your historical cost income statement. So in the current cost income statement, we are going to multiply 5 million by 225 over 150. So 225, the price index at the end of 2020, and 150, the price index at the beginning. That was the time when the equipment was acquired. So current cost, we now multiply 5 million by 225 over 150, giving 7,500,000. 7,500,000. Okay? Now we are going to determine the average current cost. And how much is the average current cost? If we have now your original cost equal to 5 million, that's the original cost. And as stated, on December 31, it's now 225 as the price index. As the price index. So we now have the price index of only 150 for the beginning. So the price index applied at the beginning, that's 1.5. You multiply it by 5 million, that gives us the amount of 7,500. Okay? So that's your ending. Now, we have to add 5 million and 7,500,000, and we divide that by 2. So we are now given the average current cost of the asset equal to 6,250,000. So the average current cost, though the current cost is 7.5 million, but the average current cost is only 6,250,000. So the difference between 7,500,000 and 6,250,000 is 1,250,000. That is the amount of depreciation that should be reported in the current cost income statement. So the answer is B as in boy. Next, number 3, what is the realized holding gain on the equipment to be reported in 2020? So the realized holding gain will be computed as the depreciation on the average current cost that was computed in number 2 above is 1,250,000. Now, from this amount, we have to deduct the depreciation on historical cost computed in number 1. So, it's 1 million. So, meaning number 2 minus number 1. So, it gives us the difference of 250,000. That is now the realized holding gain. So, the amount of the holding gain as computed based on the difference between your current cost, average current cost, depreciation, and your depreciation based on historical cost. So your answer to number 3 is B as in boy. And the last, what is the unrealized holding gain on the equipment to be reported in 2020? Okay, if the current cost at the end of 2020 of the equipment is 7.5 million, then we deduct the accumulated depreciation on current cost. That's 1.5 million. That's taken by dividing 7.5 million by 5. So the depreciation on current cost is 1.5 million, and that is also the accumulated depreciation 1 year. So the balance is your net current cost of 6 million. The net current cost is 6 million. Now, if we base it on the historical cost computation, your historical cost is 5 million, and then we deduct the accumulated depreciation on historical cost as computed in requirement number 1. It's 1 million. So the difference is the carrying amount or the book value of equipment on December 31, 2020. So finally, we compare the net current cost computed at 6 million and the carrying amount of 4 million. So the net current cost and the carrying amount of 4 million, it gives us the unrealized holding gain equal to 2 million. So we have now letter C as the answer to requirement number 4. Next, we go to 23-3. Again, we have 4 requirements. And the first is, what amount of depreciation should be reported in the historical cost income statement? So we now get the amount of depreciation on historical cost. We have now the cost of 1,150,000 divided by 5 years. Stated that the machine has a 5-year life. So we now divide 1,150 by 5, giving the historical cost depreciation of 230,000. So that is letter A. Next, in question number 2, what amount of depreciation expense should be reported in the current cost income statement for 2020? The historical cost is 1,150,000. The current cost is 1,250,000. That's given. So we add the two and it gives us the total of 2.4 million. That's the total. And now we get the average current cost, 2,400,000 divided by 2, it's 1,200,000. And the depreciation on the average current cost is 240,000. Dividing 1.2 million by 5. So the answer to question number 2 is letter C. Now we go to question number 3. What is the realized holding gain on the equipment for 2020? The realized holding gain. The depreciation on average cost is 240,000 computed in question number 2. The depreciation on historical cost computed in number 1 is 230,000. So we now have the realized holding gain equal to 10,000. That's letter B as in boy for question number 3. And last, what is the unrealized holding gain on the equipment for 2020? Again, we have the historical cost, 1,150,000. We deduct the accumulated depreciation computed in number 1, 230,000, giving us the carrying amount of the machine for 920,000. Next, with the current cost of 1,250,000 and we deduct the accumulated depreciation of 250,000 taken by dividing 1,250,000 by 5. So we have 250,000 deduct from 1,250,000. The difference is the net current cost of 1 million. The net current cost of 1 million, then we deduct the carrying amount of 920,000, giving us the unrealized holding gain of 80,000. The unrealized holding gain of 80,000. So, the answer to question number 4 is letter C. We now go to 23-4. We have only one question here. In the statement of financial position restated to current cost, what is the net current cost of the property, plant, and equipment? So we are now given the 2018, the 2019, and the 2020 data about percent depreciated, about historical cost, and current cost. So if we have now the current cost of the equipment bought in 2018, the current cost is 1.4 million and the depreciable amount is still 70%. So we have now 980,000. For the 2019 acquisition, we have 380,000 times 80% after deducting the percent depreciated from 100%. So we now get 304,000. And last, we have in 2020, we have the amount of 440,000 being the current cost. And then we multiply it by 10%. I mean by 90%. So we get the total of 1,680,000. That is the net current cost of the property, plant, and equipment. We go to number 5 question. In such a disclosure, what total amount should be reported for the equipment and inventory? So we have now the equipment with current cost and with recoverable amount. The same with the inventory. So we are asked to state the amount that should be reported for the two assets. The entity voluntarily disclose information about current cost at year end. Okay, so what total amount should be reported? Our equipment is stated at the recoverable amount of 95,000, and our inventory is stated at the current cost equal to 80,000. But according to SFAS number 89, this requires that current cost for inventories and equipment shall be measured at the lower of cost or recoverable amount. So at the lower of cost or recoverable amount, so that for the equipment, we have 95,000 being the recoverable amount, but for the inventory, the lower of the two is the current cost. So we have 175,000 for question number 5. Then we go to question number 6, again with 4. Problem number 6 with 4 questions. In question number 1, in the statement of financial position restated to current cost, what is the inventory on December 31? So the inventory on December 31, 2020 is at current cost. So we have now the number of units, though our inventory here is stated, no, at 945,000 for the historical cost, but we have 15,000 units. So the 15,000 units, we are going to report it by using 15,000 units times 72. So we have now 72. The inventory is taken by multiplying 15,000 units times 72. So times 72. 72 is the price index on December 31. So the price index on December 31. So that's now the amount of the inventory cost of restated to current cost. So the current cost is 1,080,000. That's in letter A. Number 2, what is the unrealized holding gain on inventory for the current year? So in number 2, we have letter B. That's for 135,000. 135,000. 5,000, yes. And we compute this by adding the inventory on December 31, 2020. The current cost is 1,080,000, but the historical cost is only 945,000. So we now get an unrealized gain equal to 135,000. Now we go to question number 3. In the income statement restated to current cost, what is the cost of goods sold for the current year? The cost of goods sold for the current year should be stated at the average current cost. So we now have the cost of goods sold equivalent to 40,000 units. And the 40,000 units, you multiply that by 65. So it gives us 2,600,000. The average cost per unit is taken by adding 58 and 72. That gives 130 divided by 2. So the average current cost during the year is 65. So that's multiplied by 40,000 units sold. We now get the cost of goods sold of 2.6 million for number 3. In question number 4, in the income statement restated to current cost, what is the realized holding gain from the inventory sold for the current year? So we now get the realized holding gain from the inventory sold during the year. So your cost of goods sold at the average current cost as computed in number 3 is 2.6 million. The historical cost as computed given is 2,375,000. So the difference is the realized holding gain. That's 225,000. 225,000. That's now your answer to question number 4. Next, we go to problem 23-7. Question number 1. What is the inventory on December 31 at current cost? So we now get the inventory on December 31 equal to 9,000 units. So 9,000 units, it means that the 9,000 units were part of the last purchase. That's the units purchased, 9,000 units. So we just multiply it by the price index on December 31. So it's already 71. The answer to question number 1 is letter D as in dog. D as in dog. In question number 2, what is the unrealized gain on inventory for the current year? So we now begin with December 31, 2017 inventory. So January 1, we have the inventory at current cost of 639,000. That's given December 31 year end. While the historical cost by using FIFO is the amount of 7. We have the unit cost using FIFO. We have 9,000 units coming from uh, the last quarter. So the 9,000 units coming from the last quarter. So how much would be the unit cost? 630,000 divided by 9. So what will be the unit cost? Okay? So that will be the unit cost that you are going to multiply. And finally, you have your inventory with unrealized gain equal to 9,000. Take note that the ending inventory was really part of the last quarter's purchase. So 9,000 units, wala pa actually, wala pa compute ang unit cost. However, you will know that the units purchased actually remain. So we now get the unrealized gain equal to 9,000. Question number 3. In the income statement restated to current cost, what is the cost of goods sold for the current year? So we now get the average current cost of the cost of goods sold now is 30,000 multiplied by 64 by 64. So you get 1,920,000. So you add 57 plus 71, you get 128. And then you divide 128 by 2, that will give us 64. The average unit cost is 64. And then you multiply 64 by 30,000 units sold. So that's now your 30,000 units sold. You can get this figure by adding the units sold column. So actually it's 30,000 units by adding the units sold column. The the answer to number 3 is letter A. Then in number 4, what is the realized holding gain on inventory for the current year? The realized holding gain is to be computed by comparing the cost of goods sold, the average current cost at the historical cost, or FIFO, we compare, no? So the average current cost is 1,920,000 computed in question number 3. And we have the historical cost using FIFO at 1,785,000. So you can just get the total historical cost excluding that of the fourth quarter. You now get your total historical cost equal to 1,785,000, though you still have your beginning inventory of 400,000. Okay? So you add the beginning inventory plus the historical cost of the units first, second, and third quarters, not the fourth quarter, because that's still part of your ending inventory. So the historical cost using FIFO is taken by adding the historical cost from the beginning inventory plus the first quarter, second, and third quarters. Total 1,785,000, giving us the realized holding gain of 135,000. So that's now letter B as in boy. B as in boy. Okay? So we now get, we still have one straight problem here. So what am I going to do? I'll give you the letter answers to problems 8, 9, 10, and 11, as well as 13. and then we will solve or answer the straight problem. So let's now go to problem 23-8. Question number 1, 23-8. The letter answer is A. Question number 2, the letter answer is B as in boy. Question number 3, the letter answer is B as in boy. And question number 4, letter answer C. Then for 23-9, with questions 1 to 4 again, 23-9, question 1, answer is B as in boy. Question 2, C. Question 3, D as in dog. And question 4, A. For 23-9. Then we go to 23-10. 23-10, question number 1, answer A. Question number 2, answer C. Next, for 23-11, the answer is D as in dog. Then question number 13, for the multiple choice answers. Number 1, dog. Number 2, C. Number 3, A. Number 4, and number 5, C. Okay, so these are your answers to the problems. Now I am going to discuss the straight problem. By the way, the straight problem for chapter 22, we are posting that in the solution section. So you can just refer to that section. The solution is there and it's quite long. Okay, so we now go to 23-12. Required. Prepare an income statement and a statement of financial position in accordance with current cost accounting. So we are now given the corporation formed on January 1, 2020. The entity reported the following financial statements pertaining to the first year of operations. So notice that you are given your income statement by using historical cost. Now we have sales, cost of goods sold with beginning inventory, add purchases. So we have the ending inventory. Finally, you get your gross income by deducting your cost of goods sold from sales. Then we deduct operating expenses, including depreciation. We have your income before income tax, deduct income tax. Finally, we have our net income. Okay. Now, that amount of net income is carried forward to your retained earnings section of the statement of financial position. So we are adding there 650,000. Now, for the assets, we have cash, accounts receivable, inventory, land, equipment, 10-year life, accumulated depreciation. Total assets, 3.7 million. Then for liabilities, we have accounts payable, notes payable, income tax payable, share capital of 2 million, and finally your retained earnings. You have declared dividends of 200,000. Now, the current cost information on December 31, 2020. Cost of goods sold at average current cost, 3.5 million in lieu of 3.2 million being the historical cost. Inventory at year end, December 31, is 1.5 million in lieu of 900,000. 1 million for the inventory at year end in lieu of 900,000. Then we have land of 1.5 million given as cost is 800,000. Equipment 1.6 million. The original cost is 1 million. So we have to prepare uh, an income statement and a statement of financial position by using current cost. So we now begin with the income statement. The income statement for we start with sales. Given is the amount of sales of 5 million. Then we are going to use cost of goods sold as given at current cost is 3.5 million. So our gross income at current cost is 1.5 million in lieu of 1.8 million. Okay, for the other income, we have realized holding gain. Realized holding gain in the amount of 330,000. How did we arrive at the realized holding gain of 330,000? First, we have the realized holding gain in relation to cost of goods sold for 300,000 taken by comparing the average current cost of the cost of goods sold of 3.5 million and the historical cost is 3.2 million. So the realized holding gain in relation to cost of goods sold is 300,000. Then we add the realized holding gain in relation to depreciation. We have the realized holding gain of 30,000. And how did we find this? The depreciation on average current cost is taken by adding 1 million and 1.6 million. 1 million and 1.6 million. We are now given the data on the amount of current cost as well as the amount of original cost. So the depreciation on the asset that's now equal to given the equipment with the 10-year life given is the original cost of 1 million and the current cost is 1.6 million. So we now get the depreciation on average cost that's equal to 1 million plus 1.6 million is 2.6 million divided by 2. So that is 1.3 million. So 1 million plus 1.6 million divided by 2 is 1.3 million and then we divide that by 10 years as the estimated life. So we get 130,000. From 130,000, we compare the depreciation on historical cost is only 100,000 taken by dividing 1 million by 10. So you get 100,000. 130,000, the depreciation on average current cost and the depreciation on historical cost of 100,000, there is a realized holding gain of 30,000. So again, as part of other income, realized holding gain is the sum of 300,000 and 30,000. So 330,000. Then we have the unrealized holding gain. What are the items that constitute the unrealized holding gain. Unrealized holding gain is composed of the following. First, we have the unrealized holding gain in connection with inventory. So we have now the current cost of the inventory end of 1 million. Okay, given is 1 million, and the historical cost of the inventory end is 900,000. So the unrealized holding gain on the inventory is 100,000. That's the difference between 1 million and 900,000. Unrealized holding gain on inventory is 100,000. Next, we go to the unrealized holding gain on the land. The land at the current cost is 1.5 million, but the historical cost is 800,000. So 1.5 million minus 800,000, there is an unrealized holding gain of 700,000. So we now have 100,000 on inventory and 700,000 on the land. And we have now the unrealized holding gain on your accumulated depreciation. So at current cost on the equipment, the current cost of the equipment is 1.6 million. We deduct the accumulated depreciation for 10 years. So we now have the 1 year of 160,000. Current cost of the equipment, 1.6 million minus accumulated depreciation of 160,000. The net difference of 1,440,000. That's the net current cost of the equipment. Then we compare this with the carrying value of the equipment. Historical cost, 1 million. Accumulated depreciation on the equipment, 100,000. So the carrying value is 900,000. While the current cost is 1,440,000. The carrying value is 900,000. In other words, there is a holding gain. There is a holding gain. That's equal to 540,000. There is a holding gain equal to 540,000. Okay? 540,000. So we now get the total unrealized holding gain from inventory, 100,000, from equipment for 700, for the land. Okay, from inventory, 100,000, from land, 700,000, and from the equipment of a total of 540,000. The total unrealized holding gain is 1,340,000. 1,340,000. Okay? That's now your total amount of unrealized holding gain. Realized holding gain, 330,000. Unrealized holding gain, 1,340,000. Taken by adding 100,000, 700,000, and 540,000. So the total unrealized holding gain of 1,340,000 added to realized holding gain of 330,000, the total is 1,670,000. That's your other income. So we add it to the gross income of 1,500,000. We now get 3,170,000. 3,170,000. 3,170,000 total income. And we deduct the operating expenses, including the following. Operating expenses, 700,000, and depreciation for 130,000. The total operating expenses is 830,000. So the income before income tax is 2,340,000. Income before income tax, 2,340,000. And finally, we deduct income tax of 350,000. The net income is 1,990,000. 1,990,000. That is your net income using current cost accounting. And finally, we have the statement of financial position using current cost accounting. Current assets, we have cash, 500,000, accounts receivable, 600,000, inventory, 1 million. The total current assets, 2,100,000. For the non-current assets, we have land, 1,500,000. Equipment, 1,600,000 less. Accumulated depreciation of 160,000. So the net amount is 1,440,000. The total of the non-current assets is 2,940,000. The total assets is 5,040,000. Total assets. So I'll repeat the assets. Current cash, 500,000. Accounts receivable, 600,000. Inventory, 1 million. Total current assets, 2.1 million. Non-current assets, land, 1.5 million. Equipment, 1.6 million. Less accumulated depreciation, 160,000. So the net amount of of equipment is 1,440,000. Non-current assets total 2,940,000. So the total assets of 5,040,000. We go to liabilities and stockholders' equity. Current liabilities. Accounts payable, 500,000. Notes payable for 400,000. Income tax payable, 350,000. The total liabilities, which are all current, 1,250,000. For the share capital, we have 2 million. And then retained earnings, 1,990,000. That's from your net income. Net income, 1,990,000. We deduct the amount of dividends declared and paid, 200,000. So your net retained earnings is 1,790,000. For the shareholders' equity of 3,790,000. Total liabilities and shareholders' equity, 5,040,000. Okay, that's all for current cost accounting. So I hope you will study well, especially the chapters that I have not given quiz. So I am referring to chapters 22 and 23. They are parts or they are in modules number 13 and 14. So you study well those that I have not given quizzes. Okay? So God bless everyone. See you during the exam. Okay? Patay mo na ang